Question 11. A wealth management firm is contemplating motivational measures in an attempt to align the interests of managers and shareholders. To this end, the board has plans to grant managers securities that are tied to the firm's stock. Even as it ponders such a move, the board is wary of managerial incentives that could negatively affect risk management at the firm. Which of the following securities provides the best example of rewards likely to reduce managerial incentives to manage risk? So said another way, which of these securities is going to cause management to kind of do things that are maybe too risky or riskier than they should in order to reap these rewards of the of this compensation they're getting in the form of securities? So we've got a long position in the firm's stock. This in and of itself probably doesn't reduce incentives to manage risk, and that's because they're long the stock. So if they take too much risk and the stock goes down, then they're going to see that hit on their net worth. Whereas if they're more prudent and they can do things that cause the stock to go up over time, then that's going to be helpful for their net worth. So I think we can rule out A. B, a deep out of the money call option on the firm's stock. So comparing this to A so far, this would certainly be one that may cause less risk management. And that's because a deep out of the money call option is going to need to go up significantly in order for management to benefit from that call option that they're granted. And so for the stock to go up significantly, they may have to take on more risk in order to do that. So being deep out of the money may lead to more risk taking. So this could be our answer so far, but we won't circle it yet. C, at the money call option on the firm stock. So relative to B, I'd say this will be similar answer to A, where if we're at the money on the call option, we're more likely to already be, we don't need the stock to go up as much as if we're out of the money to realize some benefits there. So it's not going to be as likely that risk management would go by the wayside as in B. And then D, a deep in the money call option on the firm stock. A deep in the money call option is going to act more like a long position in the firm stock. In kind of similar comments to C, if we're already in the money, then we're going to be more likely to be kind of risk averse, manage that downside since we don't need a huge up move in the stock like we do for a deep out of the money option. So we'll go with answer B. Question 12. You've been given the following information regarding a portfolio. So we've got a bunch of different statistics here. Which of the following is closest to the information ratio of the portfolio? So information ratio, to calculate that, we're going to be using the return of the portfolio. So it's going to be this 12% number. And then we're going to subtract the return of the benchmark. And then that's going to be our numerator. And then in the denominator, we're going to be using this tracking error figure. So we'll have 12 minus 9, and that's going to be divided by 10. So let's pull that in. And so we've got return of the portfolio minus return of the benchmark divided by tracking error gives us 12 minus 9 divided by 10.3. Answer A. Question 13. You have been given the following data for a managed portfolio. So we've got beta, alpha, average return, and risk-free rate. Basing your calculations on Jensen's measure of portfolio performance, the return on the market portfolio is closest to. So Jensen's measure is going to be alpha. So let me pull in how we're going to work through this here, and then we can solve this. So Jensen's measure is alpha, and that's going to equal the return on the portfolio minus the risk-free rate plus beta times return on the market minus risk-free rate. And so just to kind of note here, basically alpha is what our return on the portfolio was, and then you subtract out what the expected return should have been from CAPM. So we want to calculate return on the market. So what we're going to be doing is we're going to be calculating this variable right here, and we're given all these other ones. So we're given alpha at 2.11. We're given the return of the portfolio, which is this average return at 12.5. We're given a risk-free rate of 3. And then we are also given beta and again risk-free rate. So essentially, this is what we're going to start at, and then we just need to kind of do the algebra out here to solve for x. I won't walk through all those steps, but this is kind of what that ends up looking like. In the end down here, we get x equals minus 12.04 divided by minus 1.55, which equals 7.7677, which after we round is going to correspond right here to answer B. Question 14. A strategy where both a long position in a call option is combined with a long position in a put option, such that both options have the same strike and expiration date is known as. So we've got two options here. We've got long call, long put, and then we've got same strike, same expiration. So A, we've got strangle. So a strangle is going to be incorrect. That it will be a long in a call and a long in a put, and it will be the same expiration date, but where it's going to differ is on the strike price. So it's going to be having a long call and a long put at different strike prices, but same expiration. So we'll rule out A. B, a bear spread. A bear spread is going to be also incorrect because that's going to be some combination of two options as well, but we're going to be using different strike prices, and we're going to be buying one of the options and selling one of the options. Whereas in this strategy here, we're long two options. So we'd be long one, short one, and bear spread. Straddle, that is going to be our correct answer, and for no reason other than this is the definition of a straddle. We're going to go long the call, long the put, same strike, same expiration date. It's essentially a play on increased volatility. You're hoping volatility increases, which is going to increase the value of both of these different options without taking any directional bet, essentially. And then D, a bearish option, we can rule that out. This is just going to be one option, not two options, and this would be something like selling a call or buying a put. You're buying the option because you're bearish. You think the underlying price is going to decline. Answer C. Question 15. Stress testing is an essential practice for assessing an organization's resilience against potential adverse and economic scenarios. During which phase of the economic cycle is stress testing most important? So we've got A, during the beginning of an economic recession, B, in the middle of an economic recession, C, in the beginning of an economic expansion, or D, after a long period of economic expansion. So stress testing is going to be important during all phases, but we want to know which is most important. So looking at these, A, beginning of an economic recession, after we're already in the recession, the stress testing is going to be less important because we've already seen that big decline. So from here, at the beginning of the recession, we would expect the business cycle to kind of start picking back up. Like if we're down here at the recession, we would expect things to kind of start expanding again. And so stress testing is probably not going to be as important. So we can rule out A and B there since we're at the B, since those are both related to during the recession. So then leaving that at C and D, we're looking at the beginning of an economic expansion or after a long period of economic expansion. For the beginning of an economic expansion, we can kind of consider that as the same as A and B. So we're coming out of this here. We're starting to see that pickup in economic activity. So it should be we should be seeing stimulus from the government and or the central bank. So there should be less risk of another quick cycle and recession here. So I think we would rule out C as well. Whereas if we have, in the case of D, a long period of economic expansion, eventually we would expect there to be some downturn. So if we've had that long period of economic expansion, we would want to make sure that we're stress testing. So again, it's important to be stress testing during all economic cycles, but D is likely the most important time. Question 16. Which of these is most likely to be a disadvantage of having a central counterparty? All right, so we've got A, liquidity risk. So this is going to be an advantage of having a central counterparty. When there's a centralized system, there's going to be more liquidity because all the participants are going to be trading through that counterparty, so they'll be able to kind of facilitate that liquidity, so there should be less liquidity risk. So that would be an advantage, not a disadvantage. B, loss mutualization. So this is another advantage of central counterparties. Because there's so many participants in these systems, the central counterparty is able to spread those losses across, essentially across all members to absorb any defaults among one or two of the members. C, lack of transparency. That's also going to be another advantage. Under a centralized system, we're going to have more transparency. The contracts for options and futures are going to be more standardized, so that provides more transparency as well. So that leaves us with adverse selection as our answer. And essentially this is a disadvantage because somebody might come to trade through a central counterparty because of these advantages up here. And they might decide not to trade OTC because they don't have good enough credit risk. So nobody on the OTC market wants to trade with them and be their be the counterparty there. So they may go to the central counterparty where they weren't able to trade OTC, so they kind of come here, which can lead to adverse selection in the participants in the centralized system. Answer D. Question 17. An insurance contract that lasts for a specified period and pays a lump sum either when the policyholder dies or at the end of the period, whichever comes first, is known as. So we've got A, term life insurance. So we can rule that out. Term life insurance is only going to pay out when the policyholder dies, not at the end of some period. B, whole life insurance. Same thing as A. Whole life insurance is not going to have some payout at the end of some period. You're only going to get paid out when the policyholder dies. C, endowment life insurance. This is going to be our answer. And for the reason that this is essentially this is the definition of endowment life insurance. And then D, universal life is a type of whole life insurance. So kind of we can rule it out on that basis as well. So basically the only one of these that pays at the end of some period, not just when the policyholder dies, the only one is endowment life insurance here. Answer C. Question 18. An analyst at a bond trading desk wants to decompose the P&L of a $5 million face value U.S. Treasury 7.5. Remember, this is related to the coupon payment, so it's going to be a 7.5% coupon of April 31, 2030 over a 6-month holding period. Currently, the bond trades at par. The position is financed with direct repo, which has an interest rate of 3%. If the market experiences a 100 basis point parallel shift in the yield curve at the end of the 6th month, what is the cash carry amount over the 6-month period? So to calculate this, it's pretty straightforward. For cash carry, we're going to use the coupon payment minus the financing costs. Coupon payment is going to take that face value of $5 million, and we're going to multiply that by the coupon payment of 7.5%, which is what the 7.5 is. And then since we're using a 6-month holding period, we're going to divide that by 2. So we get 187,500. And for financing costs, we're going to be using the direct repo interest rate and also divide that by 2 for a 6-month holding period. So we get 5 million times 0.03 divided by 2, which gives us 75,000. And then going back to that original formula up front, we just subtract out these two numbers and we get positive 112,500. Answer C. Question 19. An investor short sells 1,000 shares of XYZ Corporation in June when the price is $50 per share. In September, a dividend of 1.5 per share is paid by the company. The investor closes out the position in October when the price of the share is 45. Assuming there are no borrowing costs involved, what is the profit or loss for the investor? So on the short side, we did well here. We sold at $50 and then we closed out our position at $45. So when we're short, we want the price to fall, which it did. However, we do need to take into account this dividend here. When we're on the short side, we are paying the dividend to the long side. So this is going to take cut into our profit here. So to solve this, essentially what we do is we take that $50 starting share price and then we subtract 45. So this leads us to a gain of $5. And then we need to subtract out $1.5 from that. So we get $3.5 profit from our position and then multiply that by the number of shares that we sold, which was 1,000. So we get a profit of 3,500, which corresponds right here to answer A. Question 20. The senior management of the African Industrial Development Bank is reviewing the stress testing program post a severe financial crisis in Africa. With regard to the stress testing program, which of the following is most accurate? Answer A. Senior management is ultimately responsible for the overall stress testing program, whereas the risk department is accountable for the program's implementation, management, and oversight. So this is going to be a little bit backwards here. I guess I shouldn't say backwards. So for the overall stress testing program, senior management is not going to be responsible for that. They're going to be responsible for this second part. So they're going to be responsible for the program's implementation, management, and oversight. So for that reason, we can rule out answer A. B, the chief risk officer is ultimately responsible for the overall stress testing program, whereas the risk department is accountable for the program's implementation, management, and oversight. Again, same as we had in answer A, the risk department is not responsible for the implementation, management, and oversight. That's going to be senior management. So we can rule out B as well. C, the risk committee is ultimately responsible for the overall stress testing program, whereas the risk department is accountable for the program's implementation, management, and oversight. Same thing. We've got risk department accountable for the implementation. That's going to be senior management, though. So let's make sure D is correct. D, the board of directors is responsible for the overall testing program, stress testing program. That's correct. And then whereas the senior management is accountable for the program's implementation, management, and oversight. Also correct. So we'll go with answer D. And this is a tough question. This is something you kind of need to just commit to memory from the readings here. Answer D.